Oil prices are rising as fresh clashes between the U.S. and Iran have cast doubts on peace talks, despite both sides touting recent progress. Joining us now to discuss what it all means for the energy markets is Humza Hussain, Vice President and Director for Commodities with TD Asset Management. Humza, thanks very much for joining us.
Happy to be here.
All right, let's start with an update on what's happening with the Strait of Hormuz. We've had some clashes overnight with the U.S., between the U.S. and Iran. What's the latest, and has there been any meaningful change?
So let's look back at the last month and then look at the last few days. What hasn't changed has been that constant barrage of messaging out of the U.S., especially from Trump. These ideas that Iran has agreed to everything, the Strait is going to be open tomorrow, and obviously the objective has been to kind of manipulate the market, add volatility, and keep oil prices lower than they probably should be, and they've been mostly successful at that. What the challenge has been is to look through all of that noise, and to actually look at what's happening on the ground, and that gives you a real idea of what's happening. And so, what's happening on the ground is that not much has changed over the last month. The Strait is still closed. You're still only seeing 2 to 3 ships enter or exit over the last month, and the average before that, the normal would be 100 to 150. And so that's the real kind of barometer of what's happening. Not much has changed. So what has changed over the last few days, again, looking at Strait traffic as the barometer of peace progress, it looked like progress was being made, because yesterday you actually had 33 ships move through the Strait. And so there must have been some talks or some deal going on in the background. Again, ignoring everything that's being said, you just look at what's happening. But again, it feels like one step forward, one step back. So you look like you were making progress, and then overnight you had both US and Israel launching missiles at Iran. And so again, if you're just looking at what's happening on the ground, it kind of feels like we're back to kind of stalemate.
So given that backdrop, what are the possible scenarios that could play out from here?
It's really, really difficult. I mean, that range of outcomes is so wide. It could have been like a stalemate. The most optimistic is obviously peace, and everything goes back to normal. But that kind of feels like it's getting more and more distant. The opposite end of the spectrum is you go back into a hot war. And so it's really difficult, really difficult to say what's going to happen next. Like, who knows? Who knows?
All right, now there's been talk of the UAE and Saudi Arabia using pipelines to get around the Strait closure. Do you think that's a long-term solution, or is the Strait of Hormuz, does that remain the most important way to get oil out of that region?
Yeah, I have no doubt that UAE and Saudi are going to work on redundancy programs, and they're going to build those pipelines. Saudi's going to go west, UAE is going to go south. It's obviously not the economic thing to do, because if it was, they would have already done it. So it's a question of why you're doing it. If you're doing it because you think the conflict with Iran could escalate, and so you want to kind of protect yourself from the Strait, I don't think it's the greatest solution, because Iran has already demonstrated that they can attack Fujairah, they can attack your pipeline, and you have Houthis in the Red Sea who can also disrupt Saudi pipelines. And so if that's the objective, then I don't know. I don't know if that really solves their problem. I don't think it solves their problem. And the other question is, you're building a crude pipeline, but are you building aluminum pipeline? Are you building fertilizer pipeline? Are you building LNG pipelines? Right? Those are still, those are all there. All those assets are there because it was efficient to build those assets along the water so that you could ship it. Right? That's how all that infrastructure was built over the last 30, 40, 50 years. And so this idea that you're just going to reduce the importance of the Strait, reduce the importance of the Gulf, and find other ways to get things out is, I think, probably unlikely.
Right, now, we've been hearing some dire warnings from the IAE and others about a potential crunch point coming in June, but we haven't really seen mass cancellations of flights. I know I've got a flight planned for Europe this summer. Yeah. Have enough workarounds been found, or is there still a pain point ahead?
So you haven't seen cancellations at a large scale, but you've definitely seen your fuel surcharges go up, so the tickets are more expensive.
That I've seen.
Yeah. So we are now going into the window where things could get very, very interesting. And so just to provide some context, so the biggest kind of SPR, strategic reserves, are the US and China. And so let's look at the kind of the US situation as a proxy for what's probably happening in Europe and happening across Asia as well. So the current storage at the US SPR is 374 million barrels. The lowest it's ever been, ever since they started filling it in the late 70s, is 350 million barrels. We are drawing about 10 million barrels a week. And we can't take that reserve to zero. There is like an operational minimum. You need to maintain pressure, and some of that crude is probably earmarked for other uses for military. And so that idea is not clear, but that operational kind of critical minimum in terms of how much stocks you can hold in the SPR is probably somewhere in the 300 to 350 range. And so if we're drawing 10 million barrels a week, we're starting at 375 right now, then somewhere in the next 3 to 6 weeks, you're going to get to a critical level where you no longer have the ability to feed your demand by drawing down stocks. And so if you don't have the stocks anymore, now the only way to kind of solve the market is you need to start rationing demand. And to ration demand, you need higher prices. And we're not changing our behavior at $100 a barrel. I don't think we're going to change our behavior at $120 a barrel. And so the question is, how high do you need to get to actually change behavior? And so that timeline kind of is not concrete, but probably by the end of summer, if this situation maintains, then you're probably going to see much higher oil prices.
Okay, so with that backdrop, again, what's your outlook for oil prices from here on out?
It's tough to say on the high end where we're going to go. So it's all kind of scenario based. So if we need to get to a place where we need to ration demand, so if Strait stays closed and we kind of maintain the status quo we have right now, then the question is, where do oil prices need to go to change your behavior? They probably need to go between $150 to $200 if the Strait stays closed. On the opposite end, if things go back to normal, I don't think oil can go back to $60 to $70 a barrel. That was what it was before everything started. The new fair value of crude, because if you imagine coming out of this, not only do you return to like the normal demand, but you also have to rebuild all the stocks you've depleted, right? And so that's going to add another 1 million to 2 million barrels a day. And you can also imagine that a lot of countries around the planet are probably thinking, hey, we need to really kind of stock up and build our own SPR. So coming out of this, that demand for oil is probably higher than it was before. And so you're probably adding 1.5 to 2 million barrels of demand, and you're probably shifting that fair value from 60, 70 to probably like 80 to 100, 90 to 100. That's probably the fair value of oil over the next year, if things go back to normal. That's a big if.